Tuesday morning, before the U.S. market opens, Uranium Energy Corps reports its fiscal third quarter, the first hard production data from an American ISR miner in June.
Yeah, and at the exact same time, you've got the IAEA Board of Governors sitting in Vienna basically trying to account for 440.9 kilograms of near weapons-grade uranium.
Right.
Material that has just been completely invisible to international inspectors for 97 days. So, yeah, this is not a quiet week.
No, not at all. Welcome to this deep dive into the Uranium Unleashed week ahead briefing. This is for the week of June 8th through the 12th, 2026. And if you're listening to this, you probably know that this is a week where everything kind of collides.
Yeah, it's the ultimate collision course, really. We are watching domestic operational reality just smash directly into global geopolitical risk.
Exactly, because for the last several months, the uranium market has basically been running on, well, sentiment.
Right, good stories.
Yeah, good stories. We've seen these incredible long-term demand models published. We've seen major development green lights, and the narrative is just overwhelmingly bullish. But, stories and narratives.
They're not hard data.
Right. They aren't hard data. And that is exactly what this week is about. If you've been watching the structural supply constraint thesis building in this market, this idea that the world is building way more nuclear reactors than it has fuel for, well, this is the week that thesis gets stress tested.
Heavily stress tested.
Oh,
because the sentiment is what starts a bull market in commodities, right? It gets all the capital flowing.
Yeah.
But the hard data, the actual ledgers, the production reports, the institutional financing, that's the foundation that actually keeps it standing.
Yeah. We were transitioning from a market driven by, paper uranium excitement speculators bidding up stocks based on what could happen to a market being violently tested by what is actually coming out of the ground right now.
Exactly. And starting tomorrow morning, the market has to actually look at the ledger.
So let's start there. Let's start with the baseline for the entire week, which is Monday's UXC print. Now, for anyone who isn't deeply entrenched in the uranium trade day-to-day, the UXC US Weekly is basically the industry standard spot price indicator.
Right. It comes out every Monday.
Yeah. And Friday closed out at roughly $86.15 a pound. But the critical piece of context here, and this is what wild, the spot price has been trapped in this incredibly tight $85 to $88 range for, 8 weeks straight?
Yeah, 8 weeks, which is a total anomaly. I mean, uranium is historically one of the most volatile commodities on the planet.
But it usually swings wildly.
Exactly. When it moves violently. So seeing an 8-week plateau in the middle of a structural bull market, it indicates this highly tense equilibrium.
Like a staring contest.
That's exactly it. Buyers and sellers are in a staring contest. The market is just digesting those massive gains from earlier in the year, and they're waiting for a real physical catalyst to dictate the next leg up or the next leg down.
But the $86 spot price, that's really only half the story. And honestly, I think it's the less important half. Because the massive signal that's flashing red in the market right now is the term price.
Oh, absolutely.
Which is sitting around $95 a pound.
Yeah.
So that creates this $9 spot to term spread. And we need to unpack this. Because in most normal commodity markets, that dynamic just doesn't make any sense.
No, it doesn't.
If I can go buy uranium on the spot market today for $86, why on earth would a utility agree to lock into a multi-year contract at $95?
Because the nuclear fuel cycle, it doesn't operate on just-in-time delivery. You can't run it like a modern car factory.
Right.
A major utility operating a fleet of billion-dollar nuclear reactors, they cannot risk buying their fuel on the open market a month before they need it. It's just too risky.
Because the spot market is so small, right?
Sure. Yeah, it's relatively small. It's highly illiquid. It's basically what you tap into if you just need a marginal pound to round out a shipment. But the term market, that is the actual lifeblood of the industry.
Got it.
It represents these guaranteed streams of deliveries over the next, 3, 5, even 10 years.
It's like, I was thinking about this analogy earlier, is like seeing homeowners voluntarily paying a massive premium for a 5-year earthquake insurance policy.
Yeah.
Even when the ground isn't shaking today.
That's a great way to look at it.
Right. Because they are paying more for future guaranteed security than it would cost to just deal with the market today.
And that tracks perfectly with the psychology of a utility fuel buyer. I mean, their primary mandate, their only real mandate is security of supply.
Because the alternative is a disaster.
Exactly. If a nuclear reactor runs out of fuel, it shuts down. The baseload power drops off the grid, the utility loses millions of dollars a day, and the grid operator faces rolling blackouts. So a utility buyer looks at the global supply curve projected for 2028, 2030, 2032, and they just see a massive cliff.
A huge deficit.
Right. So they are perfectly willing to pay that $9 premium today, that $95 term price, just to ensure they actually have fuel 5 years from now. When term prices sit drastically higher than spot prices like this, it's basically the smart money signaling that they believe long-duration scarcity is a mathematical certainty.
So Monday's USC print will tell us if that $86 spot floor is holding.
Yeah.
But Tuesday is where the rubber really meets the road for domestic American supply.
Yes, big day.
Before the U.S. market opens, Uranium Energy Corp UEC, they released their fiscal third quarter earnings. And we really need to dig into the mechanics of this because the market has been completely obsessed with this idea of a U.S. uranium renaissance.
Right, this whole narrative that the United States, which consumes more uranium than any other nation, by the way, is finally restarting its domestic mining industry.
To break reliance on foreign state-owned enterprises.
Exactly. And UEC is really at the tip of that spear. They operate these in-situ recovery, or ISR, mines in places like Wyoming and Texas.
Okay, let's pause right there on in-situ recovery because we throw that acronym around constantly, ISR. But I think people who hear mining still picture, giant open pits, dump trucks, guys with pickaxes.
Hard rock mining.
Right. But ISR is fundamentally different, and understanding how it works is just so crucial to understanding why scaling this production is so difficult.
It is. ISR is, well, it's essentially a massive subterranean chemistry experiment.
A chemistry experiment.
Yeah. You do not dig a hole. What you do is you drill this grid of injection and recovery wells directly into an underground aquifer that contains the uranium deposit.
Okay.
And then you pump a liquid, it's called a lixiviant, which is typically just groundwater fortified with oxygen and sodium bicarbonate down those injection wells.
So you're pumping this fortified water underground.
Exactly. And this solution flows through the porous rock, and it actually dissolves the solid uranium into a liquid complex. And then the recovery wells pump that uranium-rich fluid back up to the surface.
And from there, it gets piped to a processing plant where they literally strip the uranium out of the water using ion exchange resins, right?
Right. They strip it, dry it, and package it as yellow cake. And then the water gets recycled back into the ground.
I mean, it sounds incredibly efficient on paper.
On paper, yes, it is highly efficient. And it carries a much, much smaller environmental footprint than conventional hard rock mining. But in reality, fluid dynamics are incredibly unpredictable.
Why is that?
Because you're dealing with the natural permeability of underground sandstone. You can experience something called channeling, where the fluid just takes the path of least resistance and completely bypasses the uranium ore.
Oh, wow. So you're pumping the chemicals, but it just goes around the deposit?
Exactly. Or you can have chemical imbalances underground that cause the uranium to literally precipitate out of the solution before it even reaches the recovery well. So, balancing an ISR well field, it takes months of precise tuning. You don't just, flip a switch and watch the uranium flow into a barrel.
Which brings us to the first critical metric we have to watch in Tuesday's UEC earnings, which is their production trajectory.
Yeah.
Because in the first 4 months of their fiscal 2026, UEC managed to produce 1 million pounds.
Right. And their guidance for the full year is 1.5 to 2.5 million pounds.
So we need to see if Q3 maintains that trajectory.
We do. If they report numbers on Tuesday that suggest they are struggling to maintain that run rate, it tells the market that the physics and the chemistry of the well field are pushing back.
But if they hit it?
If they maintain the run rate, it proves that the American domestic supply response is actually functional.
Yay.
It proves it's repeatable and capable of scaling.
Wait, let me play devil's advocate here. If they miss that target on Tuesday, say production comes online because they had one of those well field balancing issues you mentioned, does that completely break the entire thesis that America can supply its own uranium?
No, it doesn't break the thesis, but it severely delays the validation of it. And, it alters the valuation metrics for the entire sector.
How so?
Well, the equity markets have been valuing these development stage uranium miners based on their theoretical future production models, so a miss by the sector leader. It reminds the market that structural supply constraints are going to persist a lot longer than the optimists hope.
Because extracting this material is just fundamentally difficult.
Exactly. And the paradox here is that a production miss by UEC might punish UEC's stock in the short term, but it actually hardens the broader macro bull thesis.
Oh, because it proves the supply is harder to get.
Right. It proves that turning on new supply is not a given, which means the global deficit is way stickier than we thought.
Okay, that makes sense. Let's shift to the money side of UEC's earnings. The second metric we are watching is the realized price per pound. Because in Q1, their realized price was $70.04. Spot right now is $86. That is a massive gap. Why are they selling material for $16 below the spot market?
Legacy contracts. You really have to remember the history of this market to understand this.
The bear market.
Right.
Yeah.
From roughly 2011, right after Fukushima, all the way until 2021, the uranium market was locked in this brutal decade-long bear market. Prices spent years just languishing in the 20s and 30s.
Right.
So to survive, producers had to sign these long-term delivery contracts at whatever prices the utility buyers dictated. And those often had low fixed ceilings.
So they were locked in.
Yeah. And as the spot price has just ripped higher over the last 2 years, those legacy contracts act like an anchor on their revenue.
So the market wants to see if UEC is finally burning off those old cheap contracts and starting to layer in new deliveries at current market rates.
Precisely. If that realized price narrows the gap, if it moves up from $70 toward that $86 spot market, signals a fundamental shift in their revenue profile. It means the cash flow generation of these domestic miners is finally catching up to the reality of the bull market.
And then there's the third metric to watch on the UEC call, which is the Washington policy commentary. Because the U.S. government is actively trying to restructure the global nuclear fuel supply chain right now.
Yes, very actively.
We have to be clear here. We are looking at this neutrally. We aren't taking a stance on U.S. energy strategies or endorsing any political policy. We are just looking at how these government actions impact the uranium market data.
Absolutely. The data is what matters here.
Right. So we are tracking potential Department of Energy procurement contracts and looking at the downstream effects of Section 232 trade investigations.
Yeah.
Could you explain the 232 aspect?
Sure. So Section 232 of the Trade Expansion Act is a really critical mechanism. It basically allows the U.S. government to restrict imports of a commodity if relying on foreign supply threatens national security. Now, the initial 232 petition for uranium failed years ago, but the spirit of that policy has evolved into direct government intervention. I mean, we saw the recent ban on Russian enriched uranium imports, right?
Yeah, that was huge.
So the next logical step is direct DOE procurement of domestic material to build up a strategic reserve. And UAC is deeply, deeply entrenched in Washington.
So if their management team signals on Tuesday that DOE awards are imminent,
it fundamentally changes the floor valuation for U.S. producers because it means the U.S. government is actively stepping in as a buyer of last resort.
wow. Okay, so Tuesday is all about domestic execution. But while the market is analyzing, well field dynamics in Wyoming, the absolute price floor of global uranium is being dictated by events in Austria.
Yes, Vienna.
Right. The IAEA Board of Governors is meeting all week in Vienna.
This is what we call the geopolitical floor because domestic earnings, they tell us about incremental supply, but Vienna tells us about systemic risk.
Okay, let's set the stage for this. According to the briefing, we are looking at 97 consecutive days of zero inspector access in Iran.
Zero access.
And the central issue the Board of Governors is addressing is 440.9 kilograms of 60% enriched, high-enriched uranium, or HEU. Now, again, to be completely clear, we are neutrally reporting on these events. We are not endorsing any nation's political or military posture. We're just looking at the market implications.
Exactly. Our focus is strictly on how this impacts supply chains and utility risk models.
Right. So walk me through the gravity of this 440.9 kilograms.
Well, to understand it, you really have to understand the mechanics of uranium enrichment.
Because do it.
Natural uranium, when you dig it out of the ground, contains only about 0.7% of the fissile isotope U-235. That's the stuff that actually splits and creates energy.
Just 0.7%.
Right. So to fuel a commercial nuclear power plant, you use centrifuges to enrich that concentration up to roughly 4 or 5%. And that is called low-enriched uranium, or LEU.
But the material the IAEA is looking for in Iran is at 60%.
Yes. 60%. And the crucial concept to understand here is something called separative work units, or SWU.
SWU. Okay, unpack that for me.
Because enrichment is not a linear process, okay? The vast, vast majority of the time, the energy and the centrifuge capacity required to get to weapons grade, which is roughly 90% enrichment, is actually spent just getting from that natural 0.7% up to 4%.
Wait, really? The hardest part is just getting to 4%.
Yes. The physics of it are incredible. Going from 4% to 60% takes a bit more effort, sure. But once you have a stockpile sitting at 60%, you have essentially done 99% of the physical work required to reach weapons grade.
Oh, wow.
You are literally just weeks or maybe even days away from a breakout.
And the briefing notes that 440 kilos is roughly enough material for 10 weapons if it's enriched further. But here is the critical point for our deep dive. The International Atomic Energy Agency, the IAEA, hasn't had eyes on this material for 97 days.
97 days, and the IAEA is the world's premier nuclear verification agency. I mean, their entire mandate, their reason for existing, is to maintain the chain of custody for nuclear material globally, to ensure it's not diverted for military purposes.
Right.
So when they suffer a 97-day absolute blind spot over a stockpile of near weapons-grade material, the global safeguard system isn't just bending, it is fundamentally fracturing.
And the Board of Governors, which is what, 35-member nations, they're currently debating whether to issue a formal censure against Iran, refer the matter to the UN Security Council, or attempt to, reestablish diplomatic back channels.
Exactly. That's the debate happening right now.
But I have to ask, if I am a utility buyer, right, say I'm managing fuel procurement for a fleet of commercial reactors in France or, I don't know, South Carolina, why do I care?
Why do you care about Vienna?
Yeah, I mean, the highly enriched uranium in the Middle East is not commercial fuel. It is never going to power my reactor in South Carolina. So why would a diplomatic crisis in Vienna change the price I am willing to pay for commercial uranium from Canada or Australia?
That is the perfect question. And it changes the price because the uranium fuel cycle is a singular, globally fungible ecosystem.
Okay, explain that.
A utility fuel buyer doesn't just look at a spreadsheet of supply and demand. They operate this incredibly complex, multivariable risk matrix.
Walk me through the mechanics of that matrix. Like, literally, how does a headline out of Vienna trigger a procurement decision in South Carolina?
Okay, so the primary variable in their risk matrix is geopolitical stability. Commercial uranium doesn't just teleport from a mine to a reactor. It moves through international shipping lanes. It requires highly specialized conversion and enrichment facilities, and many of those are located in very complex geopolitical jurisdictions.
Right. The logistics are messy.
Very. So if the IAEA formally declares that it has lost sight of a massive weapons-capable stockpile, the probability of regional conflict in the Middle East spikes.
And if conflict erupts?
If conflict erupts, it draws in global superpowers, which immediately threatens shipping lanes, it triggers massive secondary sanction regimes, and it disrupts the logistical corridors that commercial uranium relies on.
It's almost like the geopolitical equivalent of a credit downgrade for the entire global supply chain.
That is exactly how the math works. The fuel buyer looks at this fracturing safeguard system and realizes, wow, my supply chain is structurally less secure today than it was 3 months ago.
They can't just assume the boats will arrive on time anymore.
Right. They can no longer rely on the assumption that commercial trade routes will remain open and frictionless. Therefore, the risk of their reactor running out of fuel increases.
And they can't let that happen.
Never. So to mitigate that risk, they authorize their procurement team to aggressively secure long-term supply from Tier 1 jurisdictions, places like Canada or the U.S.
So they stop haggling over the spot price.
Exactly. They stop haggling over $86 on the spot market, and they just sign the $95 term contract. The geopolitical fear institutionalizes a permanently higher price floor.
So every week that this verification failure continues, that structural uncertainty premium just compounds. It stops being a scary headline and actually becomes a permanent feature of their contracting math.
Yes.
But that is the overarching global risk. At the exact same time, literally this week, We have a highly localized physical supply shock happening in Africa.
The Niger choke point.
Right, the situation with Urano and Niger. And, we have to maintain our neutral lens here as well. We are just looking at the facts on the ground and how they impact physical supply.
Right, because the Niger situation is where geopolitical risk stops being a theoretical exercise in a utilities risk matrix, and it becomes physical trapped supply.
Let's unpack the history here, because I don't think you can understand this current stalemate without the context. Niger's military government recently revoked the Arlit mining concession held by Orano. And Orano is the French state-owned nuclear giant.
Yes.
And they have been operating in Niger for, 58 years?
58 years. I mean, we are talking about an operational history that dates back to the late 1960s.
Wow.
You have to remember, following the Second World War, France made this massive strategic pivot. They decided to build absolute energy independence through nuclear power.
Which worked, right? Because nuclear provides roughly 70% of French electricity today.
It did work, but here's the catch. France has no domestic uranium mines. None.
Oh, really?
Yeah. So they built their entire energy security apparatus on the back of supply chains, extending into former colonies, particularly Niger, Orano, and the company that came before it. They practically built the infrastructure in the Arlit region.
And the military government just severed that half-century relationship with a single cabinet decree.
Just like that. And the really critical detail here is that Niger defied an injunction from ICSID.
ICSID, what is that?
It's the International Center for Settlement of Investment Disputes. It's basically the primary arbitration institution of the World Bank. Normally, if a host country tries to seize a foreign company's assets, an ICSID injunction freezes everything and forces both parties into arbitration. But Niger simply ignored it.
They just ignored the World Bank.
Yep.
Which leaves the market dealing with the physical fallout.
Yeah.
The briefing notes there are currently over 1,000 tons of yellow cake just sitting at the mine site in Niger, essentially frozen.
And 1,000 tons of yellow cake, that is a massive volume of material. I mean, it is fully processed, it's paid for, and it is desperately needed by Western utilities.
But it's trapped.
Trapped. Because Orano's operational license was revoked, they literally cannot legally move that material through normal Western supply channels or export corridors.
And this stalemate has been totally static for 3 weeks now. There are no scheduled hearings. There are no diplomatic off-ramps happening this week. It is a default freeze.
Yeah.
What are the secondary effects if this material just stays sitting there in the desert?
Well, if it stays frozen, it acts as a massive drain on the Western supply grid. Think about the utility buyers who were relying on that steady stream of Nigerian production over the next 2 years.
But they had that factored into their models.
Exactly. And suddenly, they have a hole in their delivery schedule. They have to replace that material by stepping into the spot market or the term market, which, of course, increases demand pressure and drives the price up.
What happens if Niger decides to bypass the Western grid entirely? Like, what if they try to monetize that 1,000 tons of yellow cake by selling it outside the traditional French corridors?
That is the escalation scenario the market is terrified of.
Because it goes to Russia or China.
Right. If Niger attempts an unauthorized export of that material, say they route it to Russian enrichment facilities or sell it directly to Chinese state buyers, it permanently removes that supply from the Western calculus.
It's just gone.
Gone. And it confirms to every single utility buyer in Europe and America that African supply, which has historically been this incredibly reliable backstop, can just no longer be trusted.
Wow. So if we pull back and connect these threads, the picture for this week is incredibly tense.
Very tense.
We have an $86 spot equilibrium testing utility conviction.
Mm-hmm.
We have an American ISR production facing the physical difficulties of scaling. We have a total verification breakdown in the Middle East driving up the global risk premium. And we have thousands of pounds of African supply literally locked behind military decrees.
Right. And that confluence of pressures brings us to probably the most important dynamic in the market right now.
Which is?
Well, with existing supply choked and risk premiums rising everywhere, the industry is desperate for a savior.
They need new supply.
Exactly. They are looking for massive, secure Western supply to come online.
Which puts an incredibly bright spotlight on the mega projects, these development stage companies holding the blueprints for the next generation of supply. And the biggest blueprint in the world right now belongs to NextGen Energy.
Oh, without a doubt. NextGen's Rook-I project. It's located in the Athabasca Basin of Saskatchewan up in Canada.
And the Athabasca Basin is basically the Saudi Arabia of uranium, right?
It is. It holds the highest grade deposits on the planet. And NextGen's project is globally significant. I mean, when it's fully operational, it could supply a substantial percentage of total global demand just on its own.
So they achieved full federal permitting in March. They are sitting on over 1 billion Canadian dollars in cash. And for weeks, management has been teasing this summer 2026 construction start.
Right.
The retail market is constantly refreshing their feeds, waiting for a press release saying, hey, we started clearing the site.
But the briefing highlights something much, much more important than a site clearing announcement.
The financing package.
Yes, the NextGen wildcard. A potential $1.6 billion project financing package. They have their annual general meeting scheduled for June 30th, and there is a low probability but highly, highly impactful chance they announce that the financing syndicate has officially closed.
I really want to break down why the financing close is so much more important than a construction start. Because I was thinking about this. It's the difference between a real estate developer telling you they have the blueprints to build a billion-dollar skyscraper, and they've even hired a guy with a backhoe to start moving dirt.
Right.
Versus the bank actually clearing the billion-dollar check into their account.
Yeah.
One gets a polite nod. The other literally moves the earth.
That is the perfect distinction. It really is. Retail investors, they trade on narrative milestones, like cutting a ribbon or moving dirt. But institutional capital trades on structural de-risking.
Okay, explain that.
Well, securing a $1.6 billion debt package is the ultimate form of de-risking because banks are inherently conservative. They do not lend $1.6 billion based on a really bullish PowerPoint presentation.
Definitely not.
Exactly the opposite. A banking syndicate will put this project through thousands of hours of the most grueling due diligence imaginable.
Like what? What are they looking for?
They will hire independent geologists to stress test the ore body models. They will bring in chemical engineers to audit the metallurgy and the processing flow sheets. They'll analyze the regulatory environment, the labor availability.
Every single detail.
Right. And crucially, they will stress test the long-term uranium price floor. They need to ensure the mine remains profitable even if we enter another bear market.
So when the banking syndicate finally signs that paperwork and commits the capital, they are basically giving the project an institutional seal of approval.
Yes, they are mathematically validating the economics. And once that debt is secured, the project transitions from paper uranium to a physical inevitability.
And the briefing notes that if NextGen drops that financing news, it triggers an immediate 10 to 15% equity move.
Oh, easily. But more importantly, it triggers a sector-wide re-rating. Because if the banks are willing to underwrite NextGen at that scale, it means institutional capital officially believes in the long-term structural deficit.
And NextGen isn't the only mega project looking for the final green light this week. The briefing also tracks Bannerman Energy's Etango project down in Namibia.
Right. And Bannerman provides a really fascinating geopolitical contrast to what we just discussed with Niger.
Because Namibia is stable.
Exactly. While Niger is severing ties and trapping supply, Namibia is operating as a highly stable, completely predictable mining jurisdiction. They just granted approval from the Namibian Competition Commission for CNNC, which is the China National Nuclear Corporation, to acquire a 45% stake in the Etango project.
Which secures the demand side of the equation for Bannerman. They know who is buying the material.
Right. So now they are just waiting to announce a $321.5 million final investment decision, or FID.
And an FID is basically the board of directors formally committing the capital to actually build the mine.
Yes. And if Bannerman pulls the trigger on that FID, it adds roughly 3.5 million pounds of new supply per year by, 2028 or 2029.
And you also have Cameco waiting on the Canadian regulatory timeline to close their acquisition of TEPCO's stake in the massive Cigar Lake mine.
Right, another huge piece of the puzzle.
It feels like all of these disparate events, NextGen's financing syndicate, Bannerman's FID, Cameco's regulatory stamps, they're all mechanisms of the exact same transition.
They are. It is capital formation and regulatory execution replacing speculative narratives. It's the whole thesis finally proving itself out in the real world.
But, the thesis only holds if the demand side of the equation is as robust as the market believes.
Which brings us to Goldman.
Yes. Last month, Goldman Sachs threw a massive rock into the pond regarding future demand. We have to talk about the Goldman Sachs SMR model.
We do. On May 16th, Goldman published a research note that formally incorporated small modular reactors SMRs into their long-term uranium demand framework.
Okay, let's explain what an SMR actually is. because the math underlying Goldman's model relies entirely on the specific engineering of these new reactors.
Right.
A traditional nuclear power plant, like the ones built in the 70s and 80s, that's a massive, custom-built, gigawatt-scale behemoth.
Yeah, it takes a decade to build and costs $10 billion. Every single one is bespoke.
Right. But SMRs are designed to solve those capital and timeline issues.
Exactly. They are much smaller, typically around 300 megawatts or less. And the modular part means their components are designed to be manufactured on a standardized assembly line in a factory.
Like building a car.
Yes. And then you ship the parts to the site and assemble them. It dramatically reduces the upfront capital costs and the build times.
But, and this is the key for the uranium market, the trade-off for being small and modular is fuel efficiency.
It is. Because SMR cores are physically smaller, they suffer from something called higher neutron leakage.
Neutron leakage, okay.
Basically, to maintain a sustained chain reaction in a smaller volume, SMRs require either much more frequent refueling outages or they require fuel that is enriched to a higher level.
Which is the HLEU we always hear about.
Right, high-assay, low-enriched uranium, which is enriched up to nearly 20%.
And because a utility might deploy, say, 4 or 6 SMRs just to replace a single retiring coal plant, the initial core loads, the massive amount of uranium required to fire up a brand new reactor for the very first time, those compound exponentially.
They do. And when Goldman modeled out this specific fuel cycle dynamic across the projected deployment of SMRs globally over the next few decades, the results were just staggering.
What were the numbers?
They added a 17% upside to global uranium demand, and they projected a cumulative supply deficit of 2.3 billion pounds through the year 2045.
2.3 billion pounds. I mean, that is a completely absurd number in the context of today's market.
It's just staggering.
The entire world currently consumes roughly 200 million pounds of uranium a year. So a 2.3 billion pound deficit implies we need to discover, permit, finance, and build 10 brand new world-class megamines just to balance the market over the next 2 decades.
Yeah, the math is incredibly daunting. And the retail investment community obviously took that Goldman note and just ran with it. I mean, retail investors have been championing the SMR narrative for 5 years now.
Right. But the briefing makes a crucial point for this week. We are waiting to see if other institutional research houses like Scotiabank, Canaccord, or Bank of America follow Goldman's lead and publish similar models.
Yes, that's the next catalyst.
But why does it matter if Bank of America just, copies Goldman's homework? If the math is out there, the math is out there, right?
You would think so, but that's not how institutional capital allocation works.
How does it work?
Well, retail investors have the luxury of trading on conviction and early trends. But institutional portfolio managers, the people managing $100 billion pension funds, they require cover.
Cover.
Right. They cannot allocate billions of dollars of client capital based on a retail thesis they read on Reddit. They need major conservative banking institutions to mathematically justify the thesis in peer-reviewed research notes.
So when Goldman published the model, they essentially gave permission for the rest of Wall Street to take SMR demand seriously.
Exactly. They broke the seal. If we see a cascade of research notes this week from other Tier 1 banks citing Goldman's SMR logic, that is the moment a niche retail thesis calcifies into actual Wall Street consensus.
And when that institutional cascade happens?
That $86 spot price floor hardens into concrete because the bank's own long-term deficit models demand significantly higher incentive pricing. They know you need way higher prices to justify pulling new supply out of the ground to meet that 2.3 billion pound shortfall.
Wow. We have covered a massive amount of ground today. I mean, spanning from wellfield chemistry in Wyoming all the way to structural deficits modeled on Wall Street.
It's a lot of data.
It is. Let's pull all of this together and quickly recap the roadmap for the listeners' week.
Okay, so first, watch Monday's UXC print. We are looking to see if that $86 equilibrium holds or breaks, and whether that massive $9 spot-to-term spread compresses or widens.
All right. And second, watch Tuesday morning's UEC earnings. Does American ISR production actually meet the 1 million pound run rate hype? And is the realized price breaking free of those legacy contracts?
Third, monitor Vienna all week. How does the IAEA Board of Governors respond to Iran's 97-day inspector blackout? What do they do about the 440 kilos of unaccounted 60% HEU? Does the geopolitical risk premium spike?
And finally, keep an ear to the ground for the next-gen wire. A financing syndicate announcement could drop at literally any moment before their June 30th AGM, structurally validating the next generation of supply.
Exactly.
The core takeaway here is translation. The last several months have been about bullish sentiment, demand models, and narratives. This week is about seeing if those stories actually translate into operational reality and institutional capital movement.
The sentiment was just the warm-up. The hard data is the main event. Exactly. We started this deep dive talking about the spot-to-term spread. The idea of utility buyers voluntarily paying a massive premium for a long-term insurance policy because they see a storm gathering on the horizon. We've dissected how that $9 premium proves utilities are mathematically pricing in long-duration scarcity.
Right.
But I want to leave you, the listener, with a final thought to mull over as you watch the tickers and the news feeds this week.
We've established the supply deficit. We've established the geopolitical fracturing. What happens when they overlap perfectly?
Right. Consider this scenario on your own. If the Goldman Sachs SMR demand spike and the Niger supply freeze both calcify into permanent structural realities at the exact same moment, the world's primary nuclear watchdog permanently loses track of rogue near-weapons-grade stockpiles. Are utility buyers going to continue pricing in a simple commodity shortage? Or are they going to start pricing in sheer geopolitical panic? Because panic doesn't respect resistance lines on a chart. Keep your eyes on the data this week.